Welcome everyone, and thank you for joining us for today's roundtable. So today we are going to talk about alternative investments, and we have two great speakers for you today. So with us we have a guest speaker. We have Mr. Mukesh Dave, who is the lead portfolio manager of the Global Arbitrage Fund of Ariana Investment Management. Thank you so much for joining us today, Mukesh.
Thank you.
So just upfront, this fund is also available via Kristal, but as a disclaimer, this is solely available for accredited investors in accordance with MES regulations, of course. So, and then we also have Thomas Meichl with us, who is head of advisory at Kristal.AI. Thank you, Thomas.
Hi, everybody.
So just before we get started, we have two very, very knowledgeable gentlemen with us today. So if you have any questions whatsoever on Ariana in particular, or about alternative investments on a more general basis, please use our Q&A tool that you find. There's an icon either on the top or the bottom of your screen called Q&A. So please put your questions there, and then we'll also, of course, answer them in the course of this webinar. Yes, and if there's any other questions you might have, you can always send an email to support@Kristal.AI, or of course you can always reach out to your relationship manager. And finally, this webinar is being recorded. So if there's anything you want to review or share after we finish, we will share the link with you exclusively. So without further ado, I want to hand over to Thomas, who is going to introduce us to alternative investments on a broader scale before we look at Ariana in detail.
All right, great. Thank you very much, Barbara, for the introduction, and thanks for all our guests for joining, and thank you as well, Mukesh, for taking out the time from your busy schedule. I know a lot of people, especially people in Singapore, are eager now at the first day of eased lockdown rules. I hope that we are not going to take up too much of your time, but to make it interesting for you and make this time valuable for you. And also, as Barbara said, webinar is recorded. We will publish a link. If you have anybody that you think might be interested in the topic and you want to share what we are talking about today, please feel free to share it with these people as well, and then to reach out to us. Yeah, thanks very much. With that, I'm going to go straight away into the topic, and I'm really glad to have Mukesh here. Ariana Asset Management and especially the Global Arbitrage Fund, we have formed a partnership with Kristal quite some time ago, so over a year, I think, by now. And I'm really glad that we have Ariana available through our platform. Reason being is that it is what I would deem to be alternative, falls under the category of alternative investments. And today we wanted to say, we wanted to look at alternative investments in general, and nobody better to speak about that than Mukesh himself. So what are alternative investments and why are they so important? Generally, I think the general wisdom or the textbook definition is that these are investments or financial assets that are not correlated with the traditional asset classes like fixed income and equity, therefore are for an investor an important tool for building a portfolio and for protecting a portfolio against swings. And we have seen this also in all these instances, and especially everybody of you will remember the market behavior in March, and we have seen some days, especially around the 20th of March, where literally everything fell. Yeah, so it was from treasury bonds to equities. There was hardly a safe space to hide in, and there are some alternatives that we are looking to introduce in portfolios for our accredited investors that can be considered as an offset to risk. The traditional alternative assets are assets like gold, for example, or I even count the broader commodity index into that, which is Well, we have on a long-term basis slight positive correlation of gold with stocks, but it does function as an offset in an inflationary scenario, for example. Then the new kid on the block over the past couple of years has been Bitcoin. The cryptocurrencies in general and Bitcoin in particular has been deemed for a long time as an uncorrelated asset class with equities as well as with fixed income, and has therefore gained an enormous amount of traction in the investment community, and has also been more widely held in portfolios. But important thing is always with alternatives to look at the volatility of the underlying. Yeah. The third one is volatility as an asset class itself. Yeah. Volatility, in my opinion, is in some ways probably the best alternative investment or asset, because it's directly or inversely correlated with equities. So every time when you see a sharp sell-off, volatility tends to spike as well. There are a few instruments in the market that give access to volatility. Of course, in the futures market, the VIX volatility index futures is actively traded on the Chicago Board of Trade. There's also a volatility ETF that is available in the market for trading. But here is also the same story as with Bitcoin. The sizing is going to be the critical part in a portfolio, because this trend tends to trade at a higher volatility, and any losses that you will have in your alternative hedge in the portfolio is also going to impact your performance in other parts of the portfolio. Last but not least, we also have private equity investments. This has been, I would say, the very important asset class for the last 20 years, gradually gaining more and more traction, has become more widely available through venture capital funds and private equity funds. And we're also proud and happy that we've started this year, and actually it's just last month, to introduce the first direct private equity investments through our Kristal platform that we have launched this month. One is a US-based venture capital fund called Emergent Ventures. Another one is a direct private equity investment in Synoption. And these instruments are also an increasingly high source for investments, or destination for investments as an alternative asset class. The averages are varying in different portfolios, but I've been talking to a few family offices in the past, and what I gather is that gradually over the last couple of years, the share of private equity and venture capital investment in portfolios has been increasing, and it is for depending on the size of the portfolio, of course, but in most instances it has reached a size or allocation of anywhere between 10 to 20% as well here. So objective with alternative investments is that they are not highly correlated with fixed income and equities, because in the past, the classic balanced portfolio was 60-40, where you had your allocation to equities and bonds, one offsetting the other. But as rates have reached a zero boundary, it has become increasingly challenging to get that risk offset from a fixed income instrument. So it's no longer that we have treasuries as a risk-free rate in the market. It's now at 0%. It's actually more like a rate-free risk that some people are having in the portfolio. So you're getting a little bit too skewed on various fronts here, as it would require ever increasing equity fixed income allocation to offset equities. So therefore, alternative investments are definitely deserve more attention in portfolios across the board. This is just a little bit of a snapshot, and the chart is, I don't think it gives the true picture, but we discussed this later also with Mukesh, I think, about the comparison where we see the orange line being S&P. And I think the biggest, most direct connection is with volatility, which is the blue line, where you can see on spikes in the past where we had sell-offs. Volatility has also been spiking. Same here in March this year with the sharp sell-off, volatility spiked higher. And that was the direct offset. Gold, as I mentioned, also slightly positive correlated with equities in the long run. So that's the gray line. Bitcoin has been a little bit out of the scale, so we had to put it on a different scaling here. And that is actually also interesting because I think with a wider adoption, we have seen that Bitcoin starts to pick up a more positive correlation with risky assets as well, which has started towards the end of last year and has also helped throughout the beginning of this year as well. Another alternative asset class that is extremely important are hedge funds, and especially hedge funds that are deploying strategies which perform across different market scenarios. So classic long-short hedge funds, which aim to be risk neutral through long and short, they aim to achieve that. But also more importantly is arbitrage funds. And I want to hand it over to you, Mukesh, maybe if you can give us a little bit of an overview as to your strategy in Ariana that you are deploying, and also from your background, I would be interested to hear how it helps you to use various asset classes to achieve this performance that you have shown through your track record over the last 6 years that have been very impressive.
Sure. Thanks, Thomas. Basically, I just wanted to build upon what you said about alternatives, basically, right? So the prime objective of any alternative investments at the moment, I mean, at any point of time for any portfolio is three things. One, you're looking at correlation risk. So you basically need to have a portfolio which are uncorrelated with your normal long-only risk assets, which obviously comes with the risk premium. So you basically want a risk return profile, and you want basically uncorrelated asset class. So these are the three main things, or three main pillars of any alternative investments you're looking at. And in the normal long-only asset classes, you don't have much of a choice when it comes to risk premium, because that is inbuilt. It's given to you by the market. So you don't have a choice in that. In the sense, you can't choose a particular risk-reward point on that curve if you want to do that. But alternatives do give you an option where you can actually choose the strategies which you like, which are highly uncorrelated, or which you like in terms of the risk-return profile. And then you can plug that into your overall portfolio, and that obviously gives you a particular risk return profile which you won't be able to achieve just being in the risk premium or the market kind of a portfolio. So that's the main objective of alternatives, what you are looking at. The hedge funds do provide a huge source of this kind of alternative assets, because they are typically not, I mean, you're not looking at risk premium kind of output from those kind of hedge funds, whether it is a long short equities, or you're looking at macro, looking at relative value, looking at fixed income arb, looking at all kind of styles and drifts which you can have in hedge fund kind of a world. So that's why it becomes very important to have that as a part of your portfolio. So if you're like really trying to build an efficient portfolio, so where you have long only of the risk premium assets, and then you put in uncorrelated kind of asset class into it, then obviously the portfolio can have a different flavor depending upon your own risk return profile or risk return appetite which you have, and then you can build on that efficient frontier which you want to build in that in your overall investment scheme. So that's what I think is. So it has a very good role. I mean, it has a very big role when it mainly comes to, even for institutional guys, they look at anything which is uncorrelated or has a negative correlation, or they even have a very small correlation to the normal risk premium assets. That is very good. Even if it gives you a lower returns, that would be pretty good for to have that in your book. So as you were saying about our fund, basically, right? So we typically run, it's arbitrage strategies, which means that we are market neutral at any point of time. So we do not have any exposure to any market factors, be it rate, be it FX, be it commodity, be it credit, be it vol, be it equity. So our exposure to any particular market factor at all point of time is almost zero. Basically, that's what we try to achieve through our strategies, which means that you are looking at a fund. In terms of our objective is we want to run a very low vol kind of a fund. Low vol means that the underlying volatility of returns which you are generating should be pretty low. So like we have run for the last 6 years a vol which is anywhere between 1.5% to 2% in terms of the overall vol of the book. And a return which we are looking at, we're obviously not looking at double-digit returns because this is market neutral stuff. It is highly uncorrelated to other risk assets which you have in the marketplace. And given that, we are basically targeting a return which is anywhere between 6 to 9% per annum in terms of dollars, basically, right? So you have a very steady returns profile every month on month, which comes to you. Sometimes you might have a variability on those kind of returns, might be 1%, sometimes might be 10 basis points, sometimes might be 0.5% on another month. But overall, you get anywhere between 6 to 9% in terms of the returns, basically. And then third thing which you need is that when you have a stress kind of a scenario, for example, we had a stress in March and April this year, or we had a stress, for example, in 2015 when we had a massive meltdown in commodities and we had a massive move in dollar China in 2015. At that time, you need some kind of a protection in your returns, basically, right? So this kind of strategies is what we deploy, which are basically ARB kind of strategies. They do tend to basically protect you from those kind of stresses in the system. So they will give you positive returns in those kind of months when you have those kind of stresses in the marketplace. Our trades, basically, obviously we are asset class agnostic. So we look at all asset classes. We look at everything, whatever basically can give us any ARB opportunities, whether it be it FX, fixed income, commodities, rates, equities, vol, any of those asset classes. So we are asset class agnostic. We are geography agnostic. It doesn't matter what we are looking at. So we look at everything. We look at from Brazil all the way to Tokyo in terms of markets. And the third is, since we are from Asia in terms of our time spent here in that region, we are obviously slightly more focused in Asian markets, which is why we obviously have a lot of trades which happen in Asian markets. All basically includes all countries like India, Thailand, Malaysia, Indonesia, Korea, Taiwan, Hong Kong. And all these countries obviously have a slightly larger proportion of trades from our side when we participate in these markets. We invest in very liquid stuff. So we are looking at futures in the exchanges. We are looking at vol, exchange traded vol. We are looking at vol, which we can basically strip off from various instruments available either in OTC markets or in exchange markets, or we are looking at stripping off interest rate portion of the curve either through the exchange, the futures market, or through the basis or the cross-currency markets or any interest rate markets which is available to you either in OTC or on the exchanges, basically. So we look at all these kind of things, which is what we do. We obviously have I mean, if you look at our history, we have done about 7.1 to 7.2% kind of returns for the last 6 years, year over year. That's what we have done. Obviously, it needs a bit of a setup because we are looking at various kind of trading, which involves a lot of venues, which basically means that we trade onshore markets, we trade offshore markets. We are trying to basically take benefit of the inefficiencies which are there in the markets, which also means that we would be looking at emerging markets a lot rather than a very liquid G7 markets where you don't find that many inefficiencies, but what you can find in emerging markets. So that's what we do. This whole arbitrage trading can be, I mean, it's very asset class agnostic. So it doesn't matter what you are looking at, because you might be looking at FX forward market and you might be basically looking at only the interest rate curve, which is coming out of the FX forward market. You have no interest in FX as an asset class, but only the interest rate portion of the FX market, which you can strip off through the forward markets, basically. So to focus on asset class for us is not that material. What is material for us is what kind of style you're employing, basically, what you're doing with those market factors, basically, right? So that's why we divide our studies into 3 main segments, which is what is known as convergence arbitrage, we do risk arbitrage, and we do relative value. So these are the 3 main strategies or the styles which you can use in the marketplace. And then you can choose any asset class, you can look at it. So we can use FX as an asset class to derive rates kind of thing from there, or we can look at equity market to derive interest rates from cash futures in equity. So we can look at any other asset classes to pick up a particular market factor and then basically try to arbitrage that market factors, which might be coming from various asset classes, or which might be coming from various venues in the marketplace. So this, when you look at convergence kind of arbitrage, which basically means that you are looking at very similar asset classes or exactly the same asset classes, but it could be a different venue, or it could be coming from a different market factors basically. So you might have a scenario where you're looking at commodities which gets quoted in local currency. For example, in Thailand, a gold gets quoted, or you have a gold which gets quoted in Russian ruble. And obviously, once you have knocked off the FX risk of that contract, you would be left with a pure dollar price in gold, which doesn't match with the dollar price which is available in offshore market, for example, or available somewhere else, basically, right? So this kind of arbitrages are pure arbitrages, or the convergence arbitrages, which means that if you hold them till maturity, you will basically get those differences which you have locked into it. So, for example, if you're locked into $2 difference in the beginning of the month for a particular gold price, you will realize that $2 if you hold those contracts till maturity. But obviously, you're not looking at only realizing those values. Because this market ebbs and flows, so you might be getting into a scenario where you need to have a ability to churn this book also. So you might get into a position at $2, you might get out at 50 cents of those positions, and then again you can get back in if the market moves away from that 50 cents to $1. You get back in again, you get out again at 10 cents or 20 cents. So this is a constant trading which you do. Most of this trading, what we do obviously is a bit sensitive in terms of it. It needs to be done at slightly speed. So we obviously use a lot of machines, a lot of algorithms, and a lot of access throughout the globe in terms of trading those markets, basically. So that's where you have convergence arbitrages. It could be mainly in commodities, FX, or very similar vol kind of strategies, what we do. The second class or the second strategy set which we have is a risk arbitrage, which is basically you have merger acquisition arbs in equities. You might have a similar kind of instruments, but they might be delivered into if you hold them till maturity. So you don't have an exact offset in terms of that they are getting cash settled, but they might have a risk in terms of you have to take a delivery of certain commodities if you want to arb those markets. So those are risk arbitrages where it does have a pull to the par in terms of, because it's exactly the similar kind of instrument, but it need not necessarily go down to zero or go down to the level where there's no difference between those contracts. You might have a scenario where it doesn't go down to zero. It might have some, for example, if you are looking at copper in LME versus copper in CME, it depends obviously on the transportation cost between London and Chicago in terms of what could be the difference between those two delivery points in copper, for example. So these are risk arbitrages which do exist. Or you might have a scenario where you have a interest rate in dollar versus interest rate in Sing dollars, for example, or interest rate in Hong Kong dollar versus interest rate in US dollars. These need not necessarily go to the zero, basically, but it does have a tendency to go towards those kind of things, but it need not or necessarily go to those kind of levels. So you have to manage those kind of risk arbitrage as well in equity, commodities, or in FX kind of world. The third is relative value, where you are looking at exactly the same market factor. For example, if you have interest rate as a market factor and you basically want to borrow from the cheapest curve and you want to lend to the expensive curve, and that curve can be derived from any asset class. It can be derived from cash equity in futures, or you might derive it from commodities curve, you might derive it from FX basis cross-currency swap curve, or non-deliverable swap curve in offshore market, onshore markets. So you have various permutations and combinations which you can build on those kind of interest rate curves, which is what goes into the relative value, which is mainly the fixed income arb, which is what you do on those kind of things. So this is the overall scenario, the overall things what we do in our world. And obviously, given all these things, we do have a tendency where we have a very low vol, which is between 1.5 to 2%. We have very high Sharpe, closer to 3.5. And we have returns which are closer to anywhere between 7 to 7.5% for the last 6 years. We do target anything between 6 to 9% for in terms of the broader range, but you probably will fall around 7-8% kind of returns as we go along in these markets. And given the fact that this is obviously has a bit of a limited capacity in terms of things, because these are very inefficient markets and you don't have a huge capital you can use here. So you're looking at anywhere between $300 to $500 million kind of a size is what you can do in these markets. Beyond that, either the sharp will fall, or the returns will fall, or your risk obviously will increase beyond that. So obviously it is, if you have a given risk reward at the kind of level what we are targeting, this has a limited capacity to that extent. So that's what we broadly do. Yeah.
That's a great point. So I think it's always important to have that awareness that where's the limit of efficiency, right? And how much can you take? But Mukesh, yes. I want to ask you something. I know we talked about that when we had our last catch up, but in terms of the strategy, the breakdown in allocation between conversions, risk arbitrage, and relative value, can you share with our attendants what is roughly the breakdown and how does it change over time?
Yeah, so mainly when you have you probably, I mean, in a normal scenario, you will have 60% of your capital allocation into convergence arbitrages. So what are the factors you have to be aware of when you talk about convergence arbitrage, right? So here, what is the important factor? So in the convergence arbitrages, you don't need much of capital. You need limits because you might have a scenario where you can do a huge size in some arbitrage because you know that it is going to come to you if you hold that till maturity. But there's a limit which is given to you by a prime broker. He says you can only do this much amount on this kind of thing. So your scarce factor or your factor which you need to optimize is your risk limits which you have in various markets. So that becomes a constraint for your convergence arbitrages. So this is what you need to optimize when you're talking about convergence. It doesn't need much capital, but it needs a risk limits. It needs a counterparty limits kind of thing. So when it comes to risk arbitrages, you don't need much limits there. You need risk there. So you're basically taking a VAR kind of exposure there to some extent because the correlation might not be perfect with underlying assets. So then it will give you a bit of a VAR on those things. So you need to have those risk, which basically means that you need capital, which is more required when you're talking about risk arbitrage, which is typically around 20-25% of your book, and then you have 10-15% in relative value. So relative value obviously will need more capital, and it will need a more risk limits on both sides. But those, if you have a scenario where you can churn the book more aggressively when it comes to relative value kind of trades, if they move in your favor sometime in between, you can get out, you can get in again if it expands back to the level where it makes interesting for you. So those kind of things is what happens. So you're looking at 60, 25 to 15 is how the broad allocation works on these three strategies basically.
Okay, fantastic. Yeah, the reason why I also wanted to share this slide because I think this is this shows very good your performance across different market events. Yeah. Is it fair to say with those strategies that you deploy, is it fair to say a fair statement to make that with your strategies, if there's an event of high market volatility that leads to dislocation, therefore you will find more opportunities in convergence, in risk arbitrage, in relative value, which means ultimately your returns are, so to say, feeding on a high volatility market environment. Is that a fair statement to make?
Yeah, it is a bit fair. I mean, there are two components of it, right? So one is that, for example, if you're already into a position, then those kind of volatility where the things expand, it might hurt you in terms of mark to market, right? So you need to have always a capital available to you at any point of time. When you have this kind of scenario, you have to basically, you need to have a bit of a dexterity in terms of making sure that you don't get into those trades early so that you don't suffer mark to market losses on that. Obviously it comes back at a lag, but then you obviously results in a lower yield for yourself basically, right? So you always have a bit of this tug of war between, so you have two kind of things. One is the existing wall, which is already there where you have already trades on, and then you have a wall expansion basically, right? So in a normal scenario where you have a volatility expansion, it does help you because you might have a lot of other opportunities, but it only helps you when you have the capital available to you. If you're fully deployed, when the things are expanding or things are really going very volatile, then you don't have much of a choice. You don't have capital to deploy at that time, right? Because you're already into the market. But normally, the way we run it, we have a huge amount of cash available to us at any point of time. We run almost 70% of our book or 60% of our book is always cash, near cash kind of a thing, where we have them available to us at any point of time. So we do get the benefit out of when you have a wall expansion in the market, and well, obviously it reduces your size also because when you have a wall expansion, you don't want to take a lot of risk. Basically, you want to go in slowly. You don't really want to go in with all one force in that. So obviously, it definitely helps you in terms of return being in your favor. And obviously, if you have a scenario like Lehman kind of a scenario or something like that, then this kind of strategies do very well because we have a lot of right way risk in our book, which means that we would be long fixed income kind of instruments, we would be long dollar in the forward space. So all those kind of things does basically construe a portfolio which will do very well when you have a stress in the system, basically. But the stress should be in such a way that it doesn't result in country going bust or those kind of things, because we do run some country risk and all that. So it has to go to up to a point, but beyond that, if it goes, that it might have a scenario where you might have a problem. For example, if you have some counterparty goes bust, or if some exchange goes bust, or if some country goes bust, then you have a problem because you might have some exposure in that country, basically, right? So these are the risks you run in this kind of strategies where you might have a counterparty risk for the kind of stuff what we run, be it exchange or be it a prime broker or be it a country.
Yeah, that's a good point. Yeah, fantastic. This is really helpful and great. And I wanted to go through some of the questions. And one question that I get asked, and I wanted to pass it on to you, is with those alternative investment classes that we spoke about. What do you think, or what is in your view, in this current market environment, what is the best hedge for a balanced portfolio that is between fixed income and equity?
So obviously, given the fact that fixed income has completely collapsed around the globe, right? So if you're looking at any sovereign yields anywhere, whether it's Japan, Europe, or the US, you have just completely gone down to zero, or actually in the cases of Europe and Japan, you have gone negative, basically. Right? So which means that your traditional 60-40 is not going to work if you're looking at any yield expectations. It basically means that you need to take a lot more risk premia in, which means that your allocation to equity has to increase significantly. But then obviously, if you increase allocation to equity, then you have underlying wall which you have to take, and that underlying wall of equity, some people might not like it, because then the wall could be 15-16% and your returns at 4%, your sharp look very bad, basically, right? So but this kind of things does give rise to, or does give opportunities where you are looking at like alternatives, basically, right? So if you look at a good macro fund or a good long short equity kind of guys, which are market neutral, but which will not give you a wall which is equivalent to the underlying equity wall, for example, but which will give you returns which are comparable to the equity returns, or which are comparable to something which is palatable in terms of things. But one thing is very sure, that if you had return expectations at 60-40 balanced portfolio, that portfolio is toast, basically. I mean, it has to significantly change in terms of your mix, whether it comes to fixed income allocations to the sovereigns, or it obviously within the fixed income also there could be allocation to credit, for example, right? So, but that also, if you're looking at very high grade kind of investment grade kind of investments, then you have a Federal Reserve there, which is basically is very insensitive buyer in that market. So which will also drop your markets to a level where things might not help you. So which means that at some stage people will have to get exposure to other asset classes, which means that people look at gold, people look at equity slightly higher than the 60% kind of levels which probably people had in mind earlier. But that also obviously comes with underlying wall. So now you need a wall suppressing kind of a thing. So then you probably can look at VIX kind of a thing, where you buy cheap insurance through the wall kind of options, or through wall as an asset class itself. You plug that into your book and you try to suppress a wall which is coming through equity route, basically, which could be either alternatives or taking direct exposure to the long exposure to the wall through the VIX or through any of those VIX ETFs instruments which you have in the marketplace.
One question we have is, what are your views on private equity?
I can start with that, and Mukesh, feel free to jump in with your views. I'm be very interested to hear your views on that one. But I mean, I have private equity. I find it interesting, and it's a little bit of a it's a very emotional topic for many people, because everybody wants to invest, wants to be the first one to invest in the next Amazon or Facebook or what have you not. And I think that's kind of like the pipe dream that that is with many things here. But for me, private equity is almost a little bit like a marriage, or at least like a long relationship, because the exits, it will take usually a long time, and there's usually a long holding period that is required. So I think it is an important part in an investment portfolio, because it does have historical, depending on the manager who is managing the investments, it has high rates of return. But the difference is that it's not something that can be liquidated at a time when you might want to have that cash and when you might want to move it and invest it into something else. Yeah. If you are, however, using something different as an offset, as a risk offset, for example, gold, or a cryptocurrency for that matter, that is something where usually there's a higher liquidity. So if equities sell off 40%, there's an ability to unwind these alternative investments, or reduce the allocation at least. I would never fully unwind it, but reduce the allocation and shift it again into a bit more risky assets. And that makes it a little bit tricky in the private equity space. So in a nutshell, or to sum it up, I would say private equity is really an investment. Yeah, it cannot be seen as a trading tool, and therefore is a bit more stickier from an asset allocation.
I just want to add a few points onto this, what Thomas has said. Private equity investments, basically, the biggest advantage is that you're not getting mark to market every day, like how you get in public markets. So that's one big, you can sleep well in the night, but the problem with that kind of allocation is that you need to have a very good manager. You need to basically make sure that the leverage which is getting built up into those private equity kind of investments is not to the extent where the returns, obviously after a long period of time, you might not, I mean, your returns might not be as equal to the public markets as it could be if those things are not managed properly, which means that your returns could be lower than what you probably would have got through the public markets. But the biggest advantage of private markets is that it doesn't have mark to market. You can sleep well in the night. You don't really get worried with every tick move in S&P 500 as you see them in a normal public market investments. But you need to be careful with that, because as the returns are falling across everywhere when it comes to investments, be it equity or be it fixed income, this asset class will also have a scenario where the returns are definitely going to trail or going to be in line with what's happening in public markets. So I can give you an example. For example, we have a huge asset class in infra, which is, and if you try to compare private market in infra versus the public market in infrastructure, you will find that your return or the kind of deals which gets bought or which gets taken up in private side are almost 3 or 4 times more expensive than what they are available on public markets. Simply from the fact that people don't want to take those mark to market swings, and people are willing to pay for that, which is double the price of a normal public market listed infra equity for that matter. So you have if you have a very long-term horizon, like institutions who have 10 years horizon, 20 years horizon, people can have that as an asset class in your book. And the other issue with private equity investments is the access. People don't get access normally into this kind of private equity investments very easily. Normally it is the space which is governed by institutions more than normal retail investors or even, for example, accredited investors, which is one of the reasons why all these private banks now, like UBS and CS and all that, they want to give their clients access to this kind of private investments, which they probably didn't have it earlier so easily.
Yeah, that's a great point with the mark to market. That always in times like these with the high volatility, that's definitely a good thing to have. Yeah. It's a little bit also with real estate, and actually we have not mentioned it specifically here as an alternative investment, but real estate I think is also similar, and I think Warren Buffett has been making that comparison, or was it Benjamin Graham? It's like if you buy a house, you're not checking every day the price of your house in the newspaper. Has it fallen or has it gone up? You're looking at what you're buying. Are you happy with the business, with the foundation, with the garden and everything? and you enjoy it. Same also
Yes.
with investments. Yeah. One other question that we have from Ravindiran is about commodity cycles. So, Mukesh, maybe if you can start off with your views as to commodity cycle right now. You're also doing a lot of conversions and arbitrage in the commodity space, as you mentioned. What's your view as to where do we stand right now in commodity cycle? What are opportunities, or is there any specific view that you have that you can share?
Yeah, so commodities basically, it is very specific to the markets basically, right? So if you're looking at a scarce kind of a commodities or something of those kind, then it's something which depends upon how the demand is going to come about for those kind of things. But if you're looking at general, I mean, if you're looking at, for example, oil, or if you're looking at base metals at the moment, or iron ore for that matter. I mean, if you're looking at those kind of things. So for those kind of things, I mean, if you don't have a growth in the coming through as aggressively as it was in the last, for example, 10, 20 years, what has happened? Most of this kind of commodity cycles gets governed by a massive superior growth cycle, which you see for a longer horizon. But at the moment, looking at things, we are in a scenario where you're going to be into lower growth kind of a thing for foreseeable future. You're looking at, so all those commodity cycles would be very, very small cycles at the moment when they basically react to the fact that China might come and announce one huge infra spending for next year, or the US is looking at a $1 trillion of a package for infra spending. So most of those things will get governed by those kind of moves at the market. But the underlying growth, which is possible through what we have at the moment in the world economy, whether it's through, I mean, there are the three main factors of growth, which is basically you have a population growth, you have a productivity growth, which is what, and you have any massive technological change which can derive or which can drive the growth going forward. And all these three factors at the moment, if you look at in an foreseeable future, we don't really see a massive super cycle coming from any commodities for that matter at the moment. I mean, they might have some kind of a push in between through the infra spending and all that, but most of the spending which is needed to be done either by China has already been done. I don't think so they can build more ghost houses or some more roads which go or lead to nowhere. Obviously, there's a huge need for infra spending in the US, given the fact that they haven't spent money on those kind of things for a long time. Or you probably need to have a developing countries like in Africa where they need to spend money on the infra kind of side. But that kind of a demand can easily be satisfied by the kind of growth which could be there on base metals, for example, iron ore or copper or any of those things, or even for given the renewables, which is already taking care of most of the energy needs of the world as we go along. The oil requirements also will be in a scenario where it doesn't need to be in that super cycle, because most of the energy need can be met by new technological advances in renewables for that matter. So I really don't see much of a impact coming onto the commodities going forward through the growth route at the moment.
Mm. Yeah, to add on to that, I think I view the commodities cycle. I would say long term, I'm very bullish on commodities, and that's for one reason, and that reason alone is the relation, because the commodities are generally traded in dollars. So if you look at it from a dollar perspective, I think there is more room to catch up, and I think we are all a little bit conditioned on what is the price in dollars. Like everybody's looking at gold price in prices of US dollars per ounce. But if you look at the price of gold in Russian ruble or in euros or in Japanese yen, for that matter as well, even it has been exorbitant. Yeah, all these currencies have been like it has been mitigated, or it has been a little bit tainted by the performance of the US dollar to some extent. But that's the question, and I think that's kind of like where for me the long-term picture comes in. The question is, for the commodity cycle, what's going to happen in the next 3 to 5 years with the US dollar? that will determine the price level.
Yeah, that would have more impact on the precious metal, I would guess, because that's where you need to be long gold or those, or even, for example, Bitcoin for that matter. So anything which has a storage value will have more of obviously that's one thing which is going to be quite certain from dollar perspective, that currency, dollar as a currency will obviously get better as we go along in the next 4 or 5 years. Given the fact that the kind of deficit these guys are running, even after the reserve currency status, I think they will have to, they will obviously will have a massive depreciation coming through in dollars going forward.
Yeah. Great, thank you. Mukesh, we have one great question from Raj here. So given where the markets are currently in terms of valuations across asset classes and the dislocation between the real economy and earnings as well, for that matter, versus the prices, in your view, what are asset classes that still offer a good value over the next 6 months leading into the US elections?
So you still have some of the credit markets are still dislocated, because even if Fed is participating in some of the markets, but it's still not has gone down to the level where it should. So those markets are still, I mean, if you look at closely into some of those markets which have been completely battered by what was happening. For example, you're looking at if you have a view on the market where you say that airlines are going to come back and any of those things are going to come back as things improve, then those things are still much battered, even in corporate credit space or even probably in equity side, basically. Right? So you have to look at the sectors which are basically battered. For example, even in some of the energy sector, which is quite battered at this thing, and which might have a slightly lower correlation to that asset class. For example, if you're looking at pipelines in the US, or you're looking at some of those gas pipelines, which obviously carry gas to the extent that it needs to be carried, but obviously it doesn't have a direct correlation with gas prices, for that example, right? So you have to look at those kind of assets which have got battered along with those underlying assets, which is probably have a lower correlation to that asset class for the time being. So there are a lot of opportunities on those space at the moment, where obviously there has been a lot of indiscriminate battering of those asset classes, which has happened, be it equity or be it or some corporate credits of those companies, basically. So that's what you need to look at. So as the things basically bounce back, or as the things basically recover, or we have some hope for some treatment or some vaccine coming through in next 6 to 8 months, then you should be looking forward to those kind of asset classes, basically, where the things have completely got battered, and you can basically be contrarian to those kind of instruments which you can participate either in equity or corporate credit, for that matter.
Okay, great. Yeah, I probably agree with that. I think we also had the infrastructure, utilities. That's one of our calls that we also still have there, because the earnings have actually been not as badly impacted in that sector compared to other parts of the market.
Yeah, there will be good cash dividend yield for some of those asset classes. For example, if you're looking at airports, whether it's Shanghai, Sydney Airport, any of those places, once things come back, their dividend yields are pretty attractive compared to where the fixed incomes are at the moment. So you should look at those kind of cash dividend yields of the equities, which are looking very attractive at the moment. They've obviously got battered in the whole melee where they were getting shut down. But now as the things come back, I think those would be, even if they're able to hold their dividends at half the level of what they were doing it previously, it still makes huge sense from that perspective.
Yeah. Fantastic. We don't have any other questions in our queue right now. But if there is anything else that any of you can think of, or anything that comes to your mind, please send us an email. If it's a question for Mukesh, I will forward it to you, and we will get back to you by email. But other than that, if there's no other questions that we have, then I think maybe, Barbara, I hand it back to you.
Yes, in that case, I think we can wrap it up here. Thank you very much, Mukesh, and also Thomas, for joining us tonight. And thank you for all of our attendees as well for joining us. And yes, thank you. Have a good evening.
Thank you. Thank you very much for having me.
Thank you. Thanks for coming. Bye.
Bye.
Bye-bye.